Hello, and thank you for joining us at XM.com. This is the Weekly Outlook, a jam-packed week with central bank meetings and crucial data is coming up, all while investors are wondering whether the global economy is stepping into a recession. I'm Christina Marujos. Joining me today is our senior investment analyst, Mario Sechikiriakos. Mario, starting with the United States, the Fed is widely anticipated to deliver another triple rate hike next week, but speculation now is whether policymakers will be willing to slow down in December. Could a softer U.S. payrolls report, which will come on Friday after the Fed meeting, solidify these market expectations?
Hello, Christina. Most certainly it can. I'm actually looking for a softer than expected jobs report. But before we get into all of that, the Fed faces the following problem right now. On the one hand, they have to keep going with rate increases. The markets are fully pricing in a 0.75 percentage point move at this meeting. That's fully priced in, right? So the market reaction is really going to come down to the signals that they send about future rate increases. So on the one hand, they have to keep going with rate increases because inflation is still very high. The labor market hasn't shown any serious signs of damage yet. But on the other hand, they are starting to get cold feet. We've seen various leading indicators lately, business surveys, the yield curve, consumer confidence indices. All of those suggest that a recession is becoming more and more likely. It's just around the corner, in fact. So seeing that, Fed officials have started to get concerned that they might over-tighten. They don't want to hit the brakes too hard because monetary policy, the rate increases, of course, work with a lag, with a long lag. So the true effects of the rate increases we are getting today are only going to show up next year, right? So their concern is we don't want to do too much. We don't want to cause unnecessary economic pain. So what they've done recently is they tried to float this idea to the markets that, yeah, we're going to do another 75 basis points at this meeting, but come December, we might slow down. We might go down to 50 basis points, a half point rate increase. And the entire challenge of this meeting will be how to signal that to the markets. How does Powell open the door for a slowdown in the pace of rate increases without making it seem like a pivot, like they are surrendering, right? Because that, of course, would spark a massive stock market rally. It would bring down bond yields, and all of that would add fuel to inflation. So Powell has to find a way to signal that we're going to slow down, but that doesn't mean we are surrendering the fight, right? We're going to keep going, just at a slightly slower pace. Now, on Friday, we're going to get the jobs report. The forecasts from the economists point to another very solid jobs report. Nonfarm payrolls are expected at 200,000. However, I see some scope for disappointment. If you look at what the most recent business survey showed, they revealed a slight contraction in employment for the first time in 2 years. Since the depths of the pandemic. Meanwhile, we saw the number of people seeking unemployment benefits going up during the month. So that to me suggests that we are likely to see a softer than expected jobs report. Now, as for the dollar, even though the overall picture remains positive, we're still in an uptrend, I think there's scope for a retracement, for a pullback in the dollar. Why is that? Well, obviously the Fed is shifting into lower gear. The market is already positioned for a stronger dollar. Everyone is long dollars. It's a very crowded trade. And on the opposite side of the spectrum, we've seen the prospects for the euro improve lately. We saw a dramatic decline in European energy prices. So I'm starting to get the sense that euro-dollar is setting up for a relief rally, and that is also supported by the technicals because the pair broke a downtrend line this week.
I see. Now let's turn to the United Kingdom. Markets have been plagued by the political drama of recent weeks. What should we expect from Bank of England policymakers when they meet on Thursday?
Well, the short answer is not a lot. So I think that the Bank of England is going to play it safe. So first of all, the markets are also expecting a 0.75 percentage point rate increase. There was speculation for another bigger move, but that faded away as the budget crisis sort of calmed down. And we saw other central banks, like the Canadian one, playing it safe as well. So the markets are saying the Bank of England is going to do 75 basis points. And the market reaction, since that is fully priced in, the market reaction is going to come down to the minutes of the meeting, what Governor Bailey says during the press conference, and the updated economic forecasts. Now, overall, I think that the Bank of England is going to strike a cautious tone. From a risk management perspective, this isn't the time to be a hero. Inflation is running above 10%, but the Bank of England already expects a recession to begin this quarter, and the latest business surveys from the UK confirmed that. So I think they're going to play it safe in a sense, because if they don't, that would risk causing more panic in the bond market, and that's the last thing they want. So I'm looking for a cautious tone from the Bank of England. If so, that would probably hurt sterling. But the overall direction for the pound is really going to depend on how stock markets perform moving forward.
And finally, Marios, crossing into Australia, the Reserve Bank of Australia meets on Tuesday. What do you think the central bank will signal, and how could the Aussie perform?
Well, again, I think it's going to be a small event for the Aussie. So we are only expecting a quarter point move in Australia. That's a very small move. That's what they did last time, and they signaled they're going to slow down. And the reason is, even though inflation is still accelerating in Australia, the Reserve Bank is becoming worried about global growth. They are putting more emphasis on the economic slowdown in China, of course, being Australia's biggest trading partner, and therefore they're starting to become a little more cautious. This is a trend we've seen from several central banks recently, and I believe it's likely to continue overall. The central banks have already done most of the tightening. Now we are going to slow down probably moving forward. Now, as for the Aussie, its direction, I think that the trend is still negative, even though we saw a recovery recently. And overall, its path will be tied to the outlook for China. The outlook for China, of course, remains really gloomy. The property market is still in free fall, and we've seen some political concerns get baked into the cake as well lately. So for the Aussie, I think that any relief rallies that we see are likely to remain quite shallow.
Marios, thanks so much. This was the Weekly Outlook here at XM.com.